Welcome to the Explainer. Today, we're completely bypassing the Wall Street jargon and all that endless academic noise to uncover the time-tested philosophies of two absolute legends, Benjamin Graham and his star pupil, Warren Buffett. If you want to understand how true wealth actually compounds over decades, well, you're in exactly the right place.
We've got a clear roadmap for this explainer today, breaking things down into a 6-part foundational playbook for intelligent investing. We'll be looking at investing versus speculating, meeting Mr. Market, the margin of safety, thinking like an owner, finding the true value, and finally, the long-term game.
Part 1, Investing versus Speculating. Let's start building our foundation. Now, true investing requires immense patience, right? It's about evaluating a company's actual business performance, not just guessing where a squiggly line is going to wiggle next on a stock chart. Honestly, way too many people get caught up in that daily noise. But as Graham teaches us, a stock isn't just a ticker symbol. It's a literal ownership stake in an actual business. Stocks do well or poorly in the future because the businesses behind them do well or poorly, nothing more and nothing less. If the business delivers excellent economic results, the stock is eventually going to follow suit.
So this brings us to the money illusion. Why is holding cash actually a pretty terrible strategy over time? Well, psychologists point out that if you get a 2% raise when inflation is running at 4%, you actually feel better than if you take a 2% pay cut when inflation is strictly 0. But mathematically, you're in the exact same spot. You've lost 2% of your purchasing power either way. We absolutely have to invest to outpace this silent raider known as inflation.
Consider the stark contrast between these two concepts. An investment operation requires thorough analysis that promises both the safety of your principal and an adequate return. Speculation, on the other hand, is just trying to anticipate and profit from market fluctuations without that rigorous research. You really have to ask yourself, are you acquiring suitable securities to hold for the long haul? Or are you just playing a high-risk game of chance with your hard-earned capital?
Part 2, Meet Mr. Market. Let's look at the psychology of the stock exchange.
Benjamin Graham introduced his most famous allegory back in his 1949 Bible of Investing. Imagine you own a $1,000 share in a private business, and you've got this partner named Mr. Market. Every single day, without fail, Mr. Market knocks on your door and quotes a price at which he'll either buy your share or sell you his. But here's the catch. Mr. Market is totally manic depressive. Some days, he's incredibly euphoric and quotes a ridiculously high price. Other days, he is absolutely terrified and offers to sell for pennies on the dollar. If you let his daily emotional swings dictate your own view of the business's value, you're taking your basic advantage as a logical human being and turning it into a severe disadvantage. The truly intelligent investor uses Mr. Market's mood swings to their advantage, buying when he's fearful and selling when he's greedy.
Part 3, The Margin of Safety.
Ben Graham himself actually said this one concept distills the entire secret of sound investment into just 3 simple words: margin of safety. You see, you must demand a buffer for inaccurate forecasts. Nobody's crystal ball is perfect, right? There will always be management missteps, economic downturns, unforeseen challenges, you name it. The margin of safety is basically your financial cushion. It is the literal difference between the intrinsic value of a company and the price we pay to purchase it. Meaning you only buy a stock when the price is sufficiently lower than the actual value of the business. The wider this margin, the more leeway you have for things to go sideways before you actually lose any money. Interestingly, Graham divided investors into 2 distinct camps based on the time they can realistically commit: defensive and enterprising. A defensive investor just doesn't have the time to treat investing like a full-time business, so they require incredibly strict criteria. Things like having current assets that are at least twice the current liabilities, or a track record of uninterrupted dividends for the past 20 years. An enterprising investor, though, who puts in serious, deep analytical effort, can accept slightly looser criteria, like, say, 1.5 times current liabilities, but they still absolutely demand total financial stability and consistent earnings growth.
Part 4, Thinking like an owner. This is exactly where Graham's star pupil, Warren Buffett, took these foundational concepts and ran with them to build Berkshire Hathaway.
This ownership philosophy is exactly why Buffett completely rejects the academic obsession with modern finance theory. Business schools love to hyper-focus on a metric called beta, which treats market volatility as the ultimate measure of risk. It basically just measures how much a stock's price jumps around compared to the broader market. But Buffett points out that this is, frankly, absurd.
Value investing focuses on the fundamental economic characteristics of the business. Think about it. If a phenomenal business sees its stock drop sharply in price just because Mr. Market is having a bad day, it actually becomes less risky to buy, not more. True risk isn't volatility. It's the very real possibility of permanent capital loss. Now, look, we're all human. The thrill of speculation is tempting, and we all kind of want to roll the dice sometimes. Both Buffett and Graham understand this perfectly, but they warn strongly against letting it take over. If you absolutely must scratch that itch, they advise heavily quarantining those funds into a separate, speculative, mad money account. And here's the golden rule. Only a maximum of 10% of your funds should ever go into it. Most importantly, never, ever mingle it with your serious long-term investment funds.
Part 5. Finding the true value.
So, how do these legendary investors actually look at the math when evaluating a business? Let's peel back the curtain. While standard book value is a pretty easy accounting number to pull up, intrinsic value is really the only metric that ultimately matters for a business's long-term worth. Actually, to be precise, it's the discounted value of the cash that can be taken out of a business during its remaining life. It's essentially calculating all the cash a business will generate from today until the end of its life, discounted back to today's present value. It's not a perfectly precise number, but rather a crucial estimate that forces you to really think about the long-term cash-generating power of that company. And to pinpoint that intrinsic value, Buffett uses a brilliant metric called look-through earnings to pierce right through standard accounting conventions. Under normal rules, if you own less than 20% of a company, you only report the dividends they pay you, not the actual profits they retain. But Buffett realizes that the retained profits of companies Berkshire invests in, think Coca-Cola or American Express, are still creating massive value. So he calculates look-through earnings by adding a company's own net earnings to the undistributed earnings held within its investee companies minus incremental taxes. By doing this, he finds the real hidden economic performance of his entire portfolio.
Furthermore, Wall Street's standard cash flow analysis often drastically overstates reality. Analysts love to take operating earnings and just add back non-cash charges, like depreciation. But Buffett argues this ignores a massive, undeniable reality. Businesses have to constantly spend money on new equipment and upgrades just to maintain their competitive position. So he uses owner earnings. This is operating earnings plus non-cash charges minus required capitalized expenditures. If you don't subtract those required capital expenditures, you're just tricking yourself. Owner earnings reveal exactly what a business is actually generating for you to put in your pocket.
Part 6. The long-term game. This brings us to our grand conclusion, the extraordinary, almost unbelievable power of long-term patience. Just think about the compound growth of Berkshire Hathaway's book value per share. When Buffett took the helm in 1964, the per-share value was a mere $19.46. By the late 1990s, it had grown to nearly $20,000. That is an annual compound rate of nearly 24%. And here's the kicker. He didn't achieve this by day trading, timing the market, or chasing the latest fads. He did it simply by sticking rigidly to the core fundamental principles we've covered today. Wall Street really wants you to trade constantly because, well, that's how brokers generate their fees and commissions. But the intelligent investor knows that flitting from flower to flower destroys your returns through transaction costs and taxes. Instead, you need to concentrate on businesses with excellent economics and absolutely demand honest, able management. Minimize those transaction costs. As Mark Twain's character Pudd'nhead Wilson wisely advised, completely upending modern portfolio theory, by the way, put all your eggs in one basket and watch that basket. Having deep, fundamental knowledge of just a few great companies drastically reduces your overall risk. I'm going to leave you with this final, provocative thought. If the stock market closed for 2 whole years, if you couldn't check a single price quote during that time, would you still be completely happy owning your portfolio? Ask yourself that right now. Are you acting like a true business owner who relies on the long-term fundamentals of your companies? Or are you just playing a giant guessing game, hoping Mr. Market gives you a quick out? Think about that, and you'll know exactly what kind of investor you truly are.